I would say there is a third sell-off maybe in there. So I think there's a reasonable possibility this occurs because we've had typically you get waves of selling that are in threes. This is one big wave of selling that you had here from the double top high. You had a continuation pattern. You got a second wave of selling. This could be pattern number 3, and you could get your third. And I would be starting to think it wouldn't be as fast as that. It may not even be as fast as that, and it could start to be the final leg of dissipated weak hands. Look, a lot of people jumped in when it looked like a one-way bet with excessive leverage, and you clear that out.
Gold and silver have just undergone a series of violent moves that, at first glance, look like the market doing what markets always do: test conviction, flush weak hands, and then establish new structural levels. Francis Hunt warns there may be one more distinct shakeout to occur, a third sell-off that would clear out the speculative, highly leveraged participants who squeezed in during the recent parabolic advance. That final flush, he argues, will leave the market populated by long-term stackers and institutional holders whose buying power sets the stage for far larger, faster price moves than history has previously recorded. To put his point in perspective, the cadence at which gold has been crossing each successive $1,000 milestone has accelerated dramatically. Hunt walks through the sequence on the chart: a first $1,000 that effectively took more than a century to form, then the next 1,000 in a fraction of that time, and now thousands being added in years, months, or even weeks. That compression of time between milestones is not merely a trading pattern. He treats it as a symptom of a deeply stressed fiat system where debt plumbing and leverage are concentrating risk into the bond and repo markets. Technically, Hunt's case combines classic pattern recognition, double tops, inverted HVF squeezes, and three-wave selling sequences, with a macro overlay, crowded basis trades, repo leverage, and the sheer scale of treasury ownership concentrated through offshore hubs. The message is sober. A technical correction can look small in percentage terms, yet be the mechanism that removes the last short-term participants and sets price discovery free for the stubborn, patient buyers. This is not a call to panic, nor is it a hand-holding cheer. It is a sober briefing for investors who want to understand how the market may behave in the next phase. A defined, potentially short-lived washout, followed by an acceleration driven by real physical buying and structural shortages. In the clips to follow, Hunt walks through the charts and the plumbing that underpin this thesis. Listen for his technical markers, his target zones, and the conditions he says would invalidate the bearish path. Hunt also ties the gold story to two other threads that matter to serious investors: the shuddering fragility inside parts of the U.S. Treasury and repo system, and silver's own, more volatile geometry. He outlines a plausible scenario in which the basis trade and repo stresses amplify a market move, and he maps how silver, with its thinner market and supply constraints, could amplify the upside once the dust settles. If you find this level of analysis useful, subscribe, ring the bell, and smash the like button. We appreciate the support and hope you enjoy the video.
The gold chart I have starts at around 1883. And the first $1,000 took from 1883 to 2008. So my maths isn't that great, but 17 and 8 is around 25-ish. So you're talking about 125 years to 2008. 125 years to get that first 1,000. Then the next 1,000, which was 2008 to 2020. By the way, you only made $19.27 on gold in 2011. So it's 2008 until 2020, even though you came reasonably close. That now is an easier math to do, about 12 years. So you went from 125 to 12 years for the next 1,000. And then we had tested and traded 2,000, but we then pulled back and went right the way down to 16 from 2020 till 3,000 was 2025. That was earlier this very year that we made the 3,000, round about April on the Trump's tariff tantrum. I'll be coming back to that in a minute. It was slightly before then, actually. We had a surge to 3.5, and I'll be referring to that in a minute when we do go to the chart. So you've got 125, you've got 12, then you've got 5, and that 5 is quite a unlucky long 5 because you were pretty close to. You had we kept tapping up. It was mainly a long continuation pattern from the 2020 that we had to break out of. But anyway, let's not make any excuses. 5, and then from 3 to when you first traded 4 was essentially 6 months. So you're asking, hey, how come has this pulled back? To summarize your question and to give some context to it and why I say keep calm and carry on. You're saying, hey, how come it's pulled back? At its worst case, about 11%, maybe is about 8% now, which is actually quite small beer. And how come it's done that? And I'm saying to you, you've just knocked off in the same year 3,000 and 4,000. The other things to highlight that are fundamental while we jump on the charts here is with the gold is that you will not have made a top in gold for me with the gold silver ratio in the 80s. That just hasn't happened, especially with the shortages in silver and platinum, very thin markets and very concerning supply constraints on silver. We're just at stage 1 where we've started to go fast and we've had a bit of a pushback. I just did a few, let me just bring in these corrections that you've had so far. On the weekly chart, it's a little congested here. That's 10.26 that you pulled back so far. You had a 10.8 over here. These are all pullbacks. I should maybe do it on the 3-day. It's a bit tightly packed. You can see we were 2,536, the low for the last 12 months, and we had a 9% correction there. You've had 4%, 4%, 6%, 10%, 6%. You're going to keep having these kind of corrections all the way to 10,000 and beyond. Yeah. So it really is keep calm and carry on in terms of all of this. For the technicals, that's like what happened in the charts. Well, you have to drop to smaller time frames to see a little bit of this. And in our community, we were discussing that. And you could see that there was a double top here. We got quite a violent slam on this time frame. It's only on this time frame. It's not macro significant. And you've got to rally back up to the same level. That's a double top. It's like an M figure like that. That generates a target. That target was made on that wick. And then with inverted HVF, we saw that there would be a further dip down. So we were saying, don't buy in yet, friends, because we only trade to the long side, even though we saw the short setups in here. I'll show you this as well. And I might just drop it to a 2-hourly. That is the last bit of price behavior. We said, yes, look, another squeeze is set up. That's an inverted HVF. It's a continuation pattern further downside. That means you have another target to make, which, of course, you have made to the downside. And what's actually happened now is you've started to get some rallies. They're on holding on that. There's still some firm selling. But eventually, if they continue like this, one of two things will happen. We haven't called the bottom yet, but the momentum sell-off was highest over here. We haven't had this level of momentum sell-off since. This is more a gradient down. And the minute it started to capitulate, the buyers came in. You see a little bit of an acceleration there. Boom, you made the target, and then buyers came in. So there's a lot of money that's quite prepared. This was, again, the momentum was still a little firm to the downside and a bit grindy to the upside. So what could happen here, for those wondering what happens next, is that you could get another flag rally and another reasonably firm sell-off here. And you'll end up setting up potentially another one of these, which is like that. 1, 2, 3, which we call the HVF setup. And that is a squeeze. It's 3. It's a tightening of the volatility, something quite flat bottom like that, down, and a small bounce with a flag. And you'd probably, if this is the bear scenario, it's not only a bear scenario. I'm not calling this as my base case, but if it does that, technical traders that are short term who like to trade in any direction could short here. Or if you're a hedger and you already hold and you'd like to hedge a little bit more downside, you could sell short with us, technically trading this against your holdings. Take your target on the downside, use any profits to buy more bullion, which will at some point be going up. The point I'll make here is these patterns are also getting smaller. I'm on a 2-hour time frame now. having shown you the exponential move, the rate at which new thousands were being accumulated, this actually is just a technical correction. I would say there is a third sell-off maybe in there. So I think there's a reasonable possibility this occurs, because we've had typically you get waves of selling that are in threes. So again, I'll change color. We're talking to our Dutch friends, so let's go with the orange. Yes, indeed. Let's get nationally proactive here. This is one big wave of selling that you had here from the double top high. You had a continuation pattern. You got a second wave of selling. This could be pattern number 3, and you could get your third. And I would be starting to think it wouldn't be as fast as that. It may not even be as fast as that, and it could start to be the final leg of dissipated weak hands. Look, a lot of people jumped in when it looked like a one-way bet with excessive leverage, and you clear that out. Those aren't I would say the long-term stackers who've been stacking silver and gold for 20, 15, 10 years. They won't, so you're not being affected by that. So one more sell could be a possibility.
Hunt's chart work shows a sequence of compressing corrective structures within a larger, multi-thousand-dollar advance. The practical consequence is simple. If the market completes a final, technically orthodox third leg down, it should be treated as a distributional event rather than a change of regime. That third leg will likely be slower and less violent than earlier sharp drops because the amplitude of the moves is narrowing. The HVF squeezes and inverted HVF setups he references are characteristic of tightening volatility prior to decisive directional moves. For traders, that means watch the funnel and neckline zones he highlights. A violent breach through those targets would confirm further downside, whereas a rapid momentum-led rejection through them would flip the bias toward a bullish W bottom and an accelerated move back above key round numbers such as $4,000. From a macro perspective, this technical picture is overlaid on a market structurally distorted by leverage and crowded positioning. Hunt links the April Trump tariff tantrum episode to a short-term failure mode in the basis trade. Heavily levered positions using treasuries as collateral, financed through repo and money markets. When futures drift away from cash, contango to potential backwardation, the margin dynamics can unwind confidence suddenly. Put together, the technical setups and the institutional plumbing create a regime in which a seemingly modest technical correction could be the last clearing event before a rapid, higher amplitude rally driven by the long-term stackers and physical demand.
I'm going to do silver as well. Of course, silver is very reliant on gold. It's the king. When the king stands up from the table, everybody else is come free to move. But it was slightly different in its reversal in that it had a head and shoulder, not a double top. And we saw this. So the minute you get your first slap in the face, and then you go marginally higher, and then you get a bigger slap in the face, what you get is broadening structure. That was broadening structure. That's a megaphone, and that's an ascending broadening structure. You can see why I call it ascending, because we have what's called a splitter. This is unique to HVF method theory. You won't find it anywhere else. That's why we're powerful technicians. And when you have a bull pole with an ascending megaphone, it's tapping out. If it's descending, it's continuation. And then once you get a little bit more information, you see, well, we kind of had a flag there, and we'd already had a sell off there. The round number that is quite clearly a neckline for us is $50.65. And then you can identify subsequently. So patterns further confirm each other rather than contradict each other when you're doing it correctly. So you could have shorted the flag. Again, I don't short silver in bull markets at all. It's not my game. But technically, you could have shorted there with a very tight stop there. You would have been triggered into the head and shoulder there. You would have had the head and shoulder target right the way down there, which you eventually made as well. And you would have taken out the 50 round number. We've also put that in, which is quite an interesting level. And gold at its 4,000, you kind of got silver, not quite 50, but it's 49s, going for 49s and back into that 50 range. When we met you, we did warn. And I want to just say the following as well, for anybody who's feeling a bit intimidated by the recent price action. You're watching it on too low a time frame. We said, when you get to the 50 level, which had been resisted. And we used our standard catchphrase that you'll remember if you watch the previous video. I'm sort of leaning, I wasn't a Lionel Richie fan, but he got played so often. It's once, twice, three times, and then a lady. And it came from there. And
it's such a nice cup and handles.
It is. It's an even better HVF. We'll show you that because it gets you in earlier and gives you better targets. There's your once rejection, 1980. There's your 2011 rejection. And we said you'll get rejected at the $50 range again, which has happened. That's kind of a shooting star. Let me just put the eye on, make that all go all quiet. And 1 sec, let's move that guy. It's putting something in the way there. Let's make it go away. You can see I have a small shooting star there. We'll leave the lovely Dutch orange behind for a second, and we'll go back to our transgender pink. And there you go. Small shooting star, which is a rejection. So, you could tap out, have a little hammer, and that could be it. Or it could dip a little longer. But again, this is an incredibly bullish structure. So it's the fourth time that you get your huge move for silver runners. You needed to make the third visit to the $50 range and get rejected. Watch the previous video when we were with you. We would have highlighted this when we covered silver. Now, why we say this is an ascending HVF, not a cup and handle, or it is both, but why the one is far more powerful than the other. We, with our drawing tool, generate real live targets. And you've seen how our targets work on the smaller time frame. They're more reliable on bigger time frames, and they've already shown themselves to be exceedingly reliable on what we've just shown you now. So that is an upside on a log scale chart. And this is one of the biggest structures. It is actually the biggest structure I'll ever trade in my entire trading career. And I've been in the trading space for a very, very long time. And the bigger the time frame, the more the reliability. But what people forget is when you're on a quarterly chart like this, you really need to set and forget and relax. Most people's time frame, they're wired too quick. They jump in, they jump out and all of it. You're best served by just being net long. Now, that's an investor in many instances, but you can actually leverage trade this. So for us, you triggered this pattern quite some time ago. It was July in 24, I think it was, or 23, when you ran that 23. And you've made our first target, and we normally get a little bit of a pullback after you've run there. That's what's potentially going. The best phase is yet to come, though. And it doesn't look like much because I've got it on a log scale. But your next interim target is $90, nearly $91. And again, I'm going to just take it off log scale for a while so that people realize what kind of a call that is we're making. We're not shy. You're not getting easy calls here. You're getting massive calls. You're getting massive calls. When this is done, possibly pulling back. Hey, it could come all the way back and rest on the first target. It's often a key level. Or it's nearly done now and might just have a short pullback and a little final dip down. It could technically even come back to our green line. It's not always does that, but we call that a return move. With the shortages and fundamentals, I think that's going to be hard. But maybe if we have a huge financial crisis, a demand-destroying event, and, banks have been aced, and there's nobody building anything, solar panels aren't made, no one's buying. We really stopped the clock on the economy, kind of like what we'd tried before in March 2020, then, you could quite well have a pullback all the way to 30. It's not a call that I'm making, but the next move is this move. Whatever it does to the downside, let's say it does that, it's running to the doorstep of 3 digits as part of its next major move. But remember, each candle is 3 months. It doesn't mean tomorrow it's doing that or next week necessarily. This could take 3, 4, 5, 6 weeks. It could take till the end of the year to happen on a pullback. It might not. It might be 3 days. I can't answer that. How long is that piece of string? I can't tell you. But if you're staying in for the long run, the next time you have a major significant pause will be in this level. You may have technically just run 100 and done 101, 103 and been smacked down, a little bit of Mr. Slammy action, or you would have balked at the 100 and you'll be sitting in the mid-90s winding up for that key psychological level to go higher. But I can tell you, this is, we're at 80, this still is the buy, the cheap buy.
Yeah,
and
nice.
I've said before, that's 100 ounces buy. Yeah, hold that up. Let everybody enjoy a bit of real money there. Beautiful stuff. Milleted, and there's babies as well. This one, it doesn't lay babies for you, unfortunately. You have to buy them, but that's a 10 ouncer. And yeah, we've just recently visited our vault, and I just take a sample of what we have there, and I'll return them. But just to remind everybody, it's beautiful. It feels beautiful in your hand.
Absolutely.
That's real money.
If you accept Hunt's framework, the first implication for position sizing is conservatism during the washout and preparedness to add on structural signals rather than on emotion. The most reliable entry points he sketches are not the immediate short-term bounces, but either A. Validated reversals through the funnel and neckline with strong momentum, which project targets back toward the prior peaks, or B. Defined, mechanically generated buy zones where the inverted HVF and multi-timeframe targets coincide and price shows constructive confirmation. In practice, that looks like scaling in with clear stops defined by the same technical geometry Hunt uses, not by calendar dates, not by hope. Silver deserves a separate but linked approach. It is more volatile, thinner, and has structural supply quirks Hunt keeps returning to. Head and shoulder and ascending megaphone geometry on large timeframes, repeated rejections in the $50 area, and very tangible supply constraints in the physical market. Traders who respect this structure will accept wider noise while focusing on the log-scale, multi-quarter targets Hunt calls out, including an eventual run toward three-figure prices if the structural backdrop of shortages and stronger gold leadership persists. But the path to those levels is rarely linear. Expect painful counter-moves that are part of a larger trending phase. Beyond charts and targets, Hunt's deeper warning, and the part that should make institutional allocators sit up, is systemic. When you compress leverage inside the repo and basis trade plumbing, you create outsized sensitivity to small shocks. That sensitivity amplifies price moves in the very assets that function as alternative money, and it concentrates counterparty risk in obscure corners of the financial system. From an investor standpoint, the implication is to separate tactical noise from structural change. Use technical validation to confirm regime shifts, but respect that a structural repricing of fiat risk can occur with little lead time once a clearing event completes. Finally, treat this period as strategic opportunity management. Be explicit about duration. Hunt compares the time between $1,000 milestones, from a century to decades to years and now to months, to underline that market structure, not sentiment, is changing. Your playbook should therefore include clear risk limits, predefined scaling plans into confirmed technical support, an allocation to physicals or secure bullion where custody is well understood, and contingency plans for extreme events in the debt plumbing. Do not lean on leverage during these transition events. Let leverage be the tool of others whose forced exits create your buying opportunities. If you found this analysis valuable, please take a moment to like this video, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps us reach more viewers who want to understand the real forces driving the precious metals market. Thank you for watching, and see you in the next one.